Thank you so much, everyone, for joining. I'm so thrilled. Really want to welcome you all. My name is Tim Nash. I'm the founder of Good Investing. My mission is to help 1 million Canadians invest intentionally, but not just Canadians. For those joining from America, welcome. We do love our neighbors. It doesn't always feel like our neighbors love us at the moment, but absolutely, I'm here to help everybody figure out how to invest intentionally and really want to help as many people do this as possible. We're going to get into why people are divesting from Tesla. I think it's pretty self-explanatory, but we can have a little conversation about that. And then really we're going to spend the bulk of tonight opening up different funds. I'm going to show you how we open up funds and look inside to see whether Tesla's inside. This is going to be a process to see any company inside, but really obviously people thinking about Tesla, that's top of mind. So that'll be our case study. Daniel asks, Tesla exclusion from the S&P 500? No, zero chance of that. The market cap for Tesla is still very high. I don't know if it'll tell me. Here's the market cap, 909 billion. This is still going to be one of the top 10 companies on the US stock market, even if with it being down so much. It might fall down the list, but no way that it'll get excluded. Mary's asking, what about the ethical issue in Tesla Elon? So let's get to that. So let me start by just asking y'all, why do you want to divest from Tesla? Why are you here? What are the reasons that you're doing it? Sometimes it's nicer for me to read from the chat to be able to understand this. Really, when it comes to why people are divesting from Tesla, this is the number one question that I'm getting right now is people are looking to divest. And the biggest reason is that people are really upset with Elon Musk and his involvement with the US government, this DOGE, Department of Government Efficiency, where they're doing things like cutting so many different things, whether it's US aid was one of the first programs to get cut. This is an incredible program that the US has done. I have a dear friend that was involved in building renewable energy projects in emerging economies all over the world, specifically in Africa, building so many solar battery projects there. That program got completely cut. Obviously, the Parks program, the Department of Education, so many different things were happening there. I'm seeing a lot. Evan says, I did divest at $440 because he is a insert expletives here. Right? Caitlin says being invested in Tesla feels morally wrong due to its connection with Musk. Caroline says because Elon is unconstitutionally and illegally dismantling my government. Right? Mary says because Elon is literally killing people. I'm thinking about US aid. So many things here. Lots of reasons here. Really, Cadla says essentially scamming and cutting the US government departments and services to put his own services and companies in place to serve and make himself more money. So much of this has to do with Elon. I think it really is about Elon, and this is why people are so worried about it. There was the whole sort of Nazi salute thing. I'm going to err on the side of not saying any sort of personal attacks on Elon and necessarily his worldview or who he is as a human being, but I'm really going to look at actions specifically for Tesla. And that really what we can do is start to dig into understanding why a lot of people are divesting. So when it comes to looking at Tesla, there are two ESG rating firms that I use. So when it comes to ESG, this is environmental, social governance. This is code word for sustainability. What we can do is look them up on MSCI. This is Morgan Stanley Capital Indexes is one of the big ESG data providers. And we can look up Tesla here and we can start to see absolutely some flags. So when it comes to the company's commitment to reduce its carbon emissions, does Tesla have a decarbonization target? A big fat no. That this is an electric car company, but that has not measured to their own carbon footprint and has not set a target for their decarbonization of the company. So this is just where, to me, it would be such an easy thing for Tesla to be able to do this. If they really cared about climate change, this is a very easy ask from companies, is to say, hey, let's have a decarbonization target. Because of that, and because of really, I would say, a philosophy that really views a lot of sustainability measures, whether it's ESG, whether it's DEI, these things are getting labeled as woke. And so what we can do here is look at their ESG score overall. So again, this is going to be the broad, high level ESG. The way ESG ratings work from MSCI is AAA is the highest score, followed by AA, single A, triple B, double B, single B, and then triple C is the least sustainable. We can see that Tesla gets a triple B rating here, which puts them squarely in the middle for automobile companies. Okay, so there are definitely automobile companies that have a better ESG score. It's interesting, no car company, no auto manufacturer has a AAA score. The highest is AAA within that sector, right? So Tesla is very much middle of the pack when it comes to ESG scores. We can see they used to have a higher rating. Might have to zoom out just a moment there. There we go. They used to have a slightly higher rating of A. So for 2021 through 2022 and 2023, they had a single A rating, but that dropped in August of 2024, and that we can see where they're leaders, where they're average, and where they're laggards. And so again, through an ESG lens, a sustainable investing lens, that really their biggest red flags are product safety and quality, as well as corporate governance. Okay? That yes, they do have some other issues as a company, right? In terms of the carbon footprint of their product, they're just considered average because again, they don't really report on this. And they do have some labor management issue in terms of how they treat their employees. There are some pretty bad stories there. But really the red flags, the reason that it does get excluded from a lot of funds is the product safety and quality and corporate governance. I'll throw the link in the chat here. Here you go, Sylvain. Happy to do that for you. This is where we have lots of, you can look up different companies if you want to see their ESG scores here. But these really are the red flags, that the reason it does get excluded from so many sustainability funds is because of their controversies. Now, what's wild is that Elon Musk, I don't think there's a tick box for has the CEO kind of gone off the deep end, and when it comes to government involvement, this is unprecedented. So I haven't seen any like official controversy around Elon's government activities, but we absolutely have this orange flag here for product safety and quality. Tesla has had so many different recalls that if I just Google Tesla recall, there are going to be all kinds of different news stories, right, about Tesla vehicles could pose a road hazard in Canada, their 8th Cybertruck recall. There have been so many different issues. Nearly all Cybertrucks have been recalled because Tesla used the wrong glue. Throughout their history, Tesla has just had a lot of issues with their product quality. For those who are like a little bit nerdy on stuff, there's a YouTuber that I love, Mark Rober. And he's like a very big YouTuber, and he did Can You Fool a Self-Driving Car? I'll link to it in the chat here as well. But that he looked at different autopilot situations, and whereas most electric cars use something called LiDAR, which is very safe. It's a really good way of detecting things. Tesla autopilot uses what's called cameras. And really, they weren't able to detect things in fog or in heavy rain, and really it was a cost-saving measure. So again, Tesla, like the biggest red flag with them is to be able to, their product safety and quality. They do also here, they are a laggard when it comes to ownership, the corporate governance. And this is where it's really tricky understanding that when it comes to ethical investing, this question of should I divest from them or should I engage? Should we try to push Tesla in the right direction? The issue is I don't think that's going to be very successful, that when it comes to corporate governance, they have 8 people on their board of directors. One of them is Elon. One of them is his brother, Kimball Musk. There's Robin Denholm here, which really, she's the highest paid board chair on the S&P 500. So Elon was the chair of the board as well as the CEO for a long time, which is a big no-no. And so being able to, investors said, okay, you can't be chair of the board and CEO. He wanted to stay on as CEO. So he hired Robin to be chair of the board, and she is the highest paid board member in the US, right, out of all companies. There's also James Murdoch, who's Rupert Murdoch's son, which is really strange to me that James is on the is on the board here. So anywho, when it comes to the board, I would say that Elon very much does have pretty firm control over the board of directors. I know that in terms of voting shares, he controls a lot of the shares. Tesla has a funny governance structure where it requires a 2/3 majority to vote on some of the major issues, trying to replace it. So I don't think that it's going to be very effective to engage with them. I just really don't think that they're open to it. To me, this is a really interesting, they are considered a laggard there. And to me, that absolutely is a bit of a flag, and which is why I think a lot of people are looking to divest from them rather than engage with them. So this is MSCI. I love MSCI for research. The other firm that I love is called Sustainalytics. So Sustainalytics is now owned by Morningstar. So I can just show you here. Again, they're considered like medium risk from an ESG perspective. I'll zoom in a little bit here, right? That as far as automobile companies, they are 35 out of 88. So certainly not like the worst, the least sustainable car company in the world, but certainly not the most sustainable either. Whereas it really is a shame if they just did some of the basic things, and I think they could get such a good score. And that again, really does come down to when we look at the top material ESG issues, product governance. So again, this is going to be so much about product safety, business ethics, right? So this is where very interesting here, corporate governance, which I flagged, and human capital, which is how they treat their employees. So very similar from MSCI. And they have had two of these significant flags. So this is why Tesla has been excluded from a lot of the funds, that it's not, I saw someone posted in your last webinar that I attended, someone joked about the founder asshole factor. I don't mind swearing a little bit here, that this should be measured in ESG scores. Really, Magosha, appreciate that comment. I think that we don't really have an asshole score for this. Really, we are relying on some of these other issues. The fact that they've had these significant issues, these sort of level 3 controversies, is why they are excluded from a whole bunch of different funds. I'm seeing some great comments here about some specific ETFs like QCLN and GBAL. Why don't we get to that now? That it really is understanding there are a lot of reasons why people are divesting from Tesla. There are I would say fewer reasons why they are excluded from a lot of ESG funds. And so what I want to do now is, with our remaining time together, is to start to look under the hood of some of these funds so that I can teach you how to do that. First and foremost is like, how do you look under the hood for some of these ETFs, and that we can examine some of the methodologies to be able to see why it is included or why it's not included. So I've got Daniel here in the chat, says GBAL has a 5-star Morningstar rating, and it's a one decision ESG index fund. So let's start with this one, Daniel. I think this is a really good place to start, is GBAL. So GBAL is what's known as an all-in-one ETF, okay? And I love these all-in-one ETFs. This is, to me, is a wonderful innovation. That GBAL is the iShares ESG Balanced ETF portfolio, okay? And so just like many of us are familiar with mutual funds, that if you were to walk into a bank and they would try to sell you a mutual fund, there's a very good chance they would sell you a balanced mutual fund. And that this is going to be a mix of both stocks and bonds. So the analogy that I use, if for those who haven't heard this before, it's a really fun analogy, is that when we're creating an investment portfolio, it's basically like we're baking a pie, right? With any pie, you're going to have the crust and the fillings. Those are going to be your bonds and your stocks. That bonds are like the crust of the pie. They are safe and they are stable when it comes to our bonds. But the reason why we invest is for the stocks. The reason we eat pie, we want the filling, right? That's really what we're going for. The reason we want to invest is for the higher expected returns from the stocks. So that really is the sort of the bulk of what we're likely to be investing in is going to be that filling, right? And so what this is essentially is like a frozen pre-made pie, that this is going to have a mix of both stocks and bonds. Right? The way it works is that there's a little bit of a family of these. So I'm just going to show here. Let me see if it's in this little product brief here. So what we've got are these all-in-one ETFs, and they do come as a family. GEQT over here, this is going to be the riskiest one. This is going to be 100% stocks. So, Leslie, one decision means that it's a full and complete pie. So this is what I'm breaking down. This is what I call a frozen pre-made pie. GEQT is going to be 100% stocks, 0 bonds. This is probably riskier than most people. Some people like going 100% stocks. I like having some crust on my pie. So GGROW is going to be 20% bonds, 80% stocks, so a bit of a thin crust on the pie. Balanced is going to be 40% bonds, 60% stocks, right? So this, and then conservative, GCNS, refers to 60% bonds, 40% stocks. So this is going to be a very thick pie. Okay. So there are like different of these all one decision or all-in-one ETFs with different percentages of bonds inside. The analogy I use is that they have different sort of crust thicknesses. What this means is that when we look inside of this all-in-one ETF, okay, this is an ETF of ETFs. So this means, again, this is why it's a one decision, Leslie, that by buying this one ETF, we've got a balanced portfolio with 40% bonds, 60% stocks, and the stocks are globally diversified. That this has XUSR, which is the iShares ESG Advanced MSCI USA Index ETF. So this is US stocks. XCSR is the iShares ESG Advanced MSCI Canadian Index ETF. These are going to be our Canadian stocks. And then XDSR is the iShares ESG Advanced MSCI EAFE Index ETF. EAFE stands for Europe, Australia, or the Far East. These are quote unquote developed countries. I hate that term, but that is what we use in the stock market. So Europe, Australia, and the Far East. It's going to have Europe. It's going to have Australia. It's going to have Japan. It's going to have, I think, Singapore and Hong Kong are the remaining quote unquote developed stock markets that are included in this. Really, again, this is an all-in-one, that this would be the full pie, that wearing my financial planner hat, you could buy this one ETF and you're diversified. You're good to go. You don't need to do multiple things. That's why it's a one decision ETF or an all-in-one ETF, where what they do is they create this nice diversified mix with all these ETFs. And to Daniel's point, they also automatically rebalance. So this one, because it's balanced, is set at 60% stocks, 40% bonds. And then usually about once a quarter, even if stocks do well or stocks do poorly, it'll get out of whack from that 60-40 mix. But once a quarter, it's going to snap back to that 60-40 mix. So literally you could buy this one ETF and I'm wearing my financial planner hat. I'm happy. The trick is figuring out which one decision ETF, right? Which kind of, how thick of a pie crust do you want becomes our big decision. For the purposes of this one, it's really the US stocks that we care about, okay? So since we care about Tesla's a US company, what I'm gonna do is now show you XUSR, right? Which is the iShares ESG Advanced MSCI USA Index ETF. So we're now starting to just take one step down the rabbit hole to understand that in an ETF of ETFs, this is the USA Index, okay? And so now I'll give you the methodology here that they use as a case study. Every fund is going to have their own methodology. This is one that I find them to be a little bit more transparent, where they have this lovely product brief where it does show us the index methodology. So what we can see is that in order to get inside of this, that really what they do is this idea of ESG rating. So remember we talked about that ESG rating before. So any company with a score below BBB is screened out, okay? So must have a score of BBB or above. So Tesla would actually sneak through here. They have a BBB rating, right? So their sustainability score is just barely good enough that it would be included. This does get rid of roughly the bottom half of companies based on this sustainability score. Where Tesla gets caught is this controversy screen that excludes company with a controversy score less than 3. Here what we're doing is we're getting rid of the very severe controversies. And this is where Tesla does get caught, that those product recalls specifically, I really think it's those recalls that were viewed as like an orange flag and we're that like level 3. I think that's why Tesla is excluded here. And I'll show you the full list of companies in a moment so that you can see it. This one does exclude all businesses within the industry tied to fossil fuels. An exception is provided to companies with over half of their revenue from renewable energy. So some of the renewable energy utilities that are mostly renewable, but a little bit of natural gas, they're going to sneak in. I'll also point out this doesn't count financed emissions. So a lot of the banks, you might have heard me rant against the banks and financed emissions. The banks are going to sneak through as well on this methodology. It excludes company with material business involvement in adult entertainment, alcohol, civilian firearms, controversial weapons, conventional weapons, for-profit prisons, gambling, GMOs, nuclear power, nuclear weapons, palm oil, predatory lending, and tobacco. So you can see it does get rid of a lot of the quote-unquote sin stocks as well. This one does exclude cannabis. So if you want weed stocks, you're going to have to buy those separately. So this one is it is fairly strict here. Something like for-profit prisons should be a huge issue for people investing in the US right now. If you're following the story about ICE and immigration and people being detained illegally and people being extradited to other countries, people being held in these for-profit prisons. There are two companies, Core Civic and Geo Group. These are for-profit prisons that operate in the US. They are absolutely part of the prison industrial system there, which I can't stand. Right? Yes, we want to get rid of Tesla, but we also want to get rid of some of these other companies. And this fortunately does have a screen for that. So you can see like this does a really good job such that I'm going to come back to the big one. So this is like the all-in-one, the one solution that I can click on aggregate underlying holdings. And we're not going to see a lot of the big companies in here. Now it does have NVIDIA in here, right? And it does have it at a pretty high weighting. Right? And it does have the banks in here. Royal Bank, Toronto Dominion, Bank of Montreal. The Canadian banks are going to be in here. Remember, it doesn't look at financed emissions. But this is going to have no Tesla. This is going to have no for-profit prisons. It has no Apple or Microsoft or Amazon or Facebook. That a lot of those tech companies have controversies that get them screened out of this. It does have Shopify in here, to Bui's point. So if that's an issue for folks, it might be interesting to say, hey, can we get a CEO asshole sort of measure on the ESG score, right? I think that is becoming more important for folks. But you can see why this is a great option. What's cool about this one, you can see 1 to 10 of about 1,500 holdings. I can click show more, and it's going to take a moment, but this is now the entire list of every company that's in here. And because I have this level of transparency, I can do Control F and I can do search for Tesla. And it's not in here. 0 search results, right? There's going to be no fossil fuels in here. So if I search for Exxon, it's not in here. There's going to be no weapons. So if I search for Lockheed Martin, it's not in here, right? No for-profit prisons. If I search for Geo Group, okay, it's got George Weston and geography here, but no Geo Group. That this is a really nice way when we are able to get the full list of companies, we can simply do a search to be able to verify that there aren't bad companies inside of here. And I want to say bad, but companies that aren't aligned with our values. This is what I mean when I say look under the hood. Does this make sense? How are we doing here? Really, again, my dream is that when it comes to evaluating these funds, if you want to divest from Tesla, it's about, number one, if we can get a feel for the methodology of that fund, why they exclude certain things, what is their definition that they use. And then number two is being able to look under the hood, get the list of companies. We can do a search, we can scan through to see if there are any bad companies that don't align with our values in here. That's the only way we're going to really figure this out. A lot of people are going to be like, oh, Tim, it doesn't have Apple, it doesn't have Microsoft, it doesn't have Amazon. What about returns? I can tell you that the returns on this have been very standard, that if we look at a non-sustainable all-in-one ETF, so I can use something like XBAL, xbal.to. This is, if we didn't care about sustainability, right, and we wanted one of these all-in-one, like one decision ETFs, we could buy XBAL. I'll show you here, but with this one, when we click on holdings, aggregate underlying holdings, this is going to have all of those big companies. We'll give it a moment here to load because there are a lot of them. You can see Apple, Microsoft, NVIDIA, right? Amazon, Meta, which is Facebook, Enbridge, right? If I just go down the list a little bit, here we go. Tesla is in here. These are so broad based. So this is going to have everything from weapons and fossil fuels and for-profit prisons. This is going to have everything. Okay. So all the nasty stuff. So if we look at the chart for this one, right? And let me see, they've made their chart on Yahoo a little bit frustrating for me. Let me see if I can get it here. I want to get rid of these comparisons. Hold on. Oh my goodness. They have made it. There we go. If I can get rid of that one, let me get rid of that one. Okay. So here we go. Let me see if I can zoom out just a little bit. Is this going to work? If I go like that, nope. How about here? Nope. So I want the 5-year chart here. This is going to be the 5-year chart for the non-sustainable one, right? So it did very well coming out of COVID, right? And then 2022 was a pretty rough year, and then it's done very well in 2023 and 2024. And now I can do the comparison with GBAL, which is the sustainable version. And let me see, here we go. And you can see, oh, I have to get it lined up on the date. Hold on, give me a moment here. Or maybe I can, does it let me? Oh, this is so funny. Let me just get the date here. So this started, it looks like 9/7/2020. So let me see if I can make this bigger. Oh, sorry. I'm going to switch charting. Let's look at Morningstar. Yahoo has just been driving me nuts. So I'm going to do XBAL. Here we go. This is if we didn't care about sustainability. This is the iShares Core Balanced ETF portfolio. I'm going to show the interactive chart here. We're going to do it over the last 5 years. Now what I'm going to do is superimpose on this GBAL, which is the iShares ESG Balanced ETF portfolio. Now this one started on, it looks like 9/03/2020. So I'm just going to get the start dates to line up. I'm going to go to September 3rd, 2020 so that they line up. You can see here that the blue line is the non-sustainable one. The orange line is the sustainable one. That for those listening on the podcast where you don't have the visual, the lines dovetail almost exactly. There's a very strong correlation all the way through to the start of 2024, at which point the sustainable one starts to outperform by a little bit, such that in fact, this one that doesn't have Tesla, that doesn't have fossil fuels, that doesn't have for-profit prisons, has done just as well, actually maybe even a little bit better over the last roughly 5 years. Okay. So again, you don't have to sacrifice returns by doing this. There are different definitions of sustainability. I'm happy to really show people if there are other ETFs or mutual funds that you do want me to open up. I'm happy to do that. But again, these are really nice. These all-in-one ETFs are fantastic. This is like the pie with both your crust and your filling. From there, I can show you here on my website. I've got these free resources and I've got my different lists. I'll just put this link into the chat as well. And you can see I do have my list of all-in-one ETFs, right? So these are going to be the frozen pre-made pies with stocks and bonds. We also have the global stock. So if you want just the filling, just the pie filling, we can absolutely do that. And then you can pick one and then also have a bond ETF, or you can make your own pie. From there, the doing more good stock ETFs. These are the quote unquote green ETFs. This is what I call the ice cream on top, or like the whipped cream on top of the pie. You don't have to do this. And the last thing I want is for someone to put all of their money into these doing more good, like green ETFs. Not a good idea. I want most of your money to be in the pie, to be in that mix of stocks and bonds. And then this is just if we wanted to do a little bit on top of that. I saw someone in the chat earlier asked about QCLN. So I can use this as a case study. So you can see this is the First Trust NASDAQ Clean Edge Green Energy ETF. So this is a fund that is focused on a lot of green energy companies. And when we click on holdings, sure enough, you can see third from the top, number 3 company in here is Tesla. Now, this is going to be alongside things like Rivian Automotive and First Solar and Enphase Energy. And here's Brookfield Renewable Partners, right? This is where Mark Carney used to do some work at Brookfield. So this is their renewable energy utility. So this is a diversified mix of a whole bunch of green stuff and different electric car companies, but Tesla is in here. If you are looking for green ETFs that don't have Tesla. This is where my list of doing more good stock ETFs can become really helpful. Some of the clean energy ones will have Tesla, some of them won't. One that I know for sure doesn't, we had Martin Grosskopf, who's the manager of this fund, the AGF. He was on the a previous YouTube that we did, which was the oldest green fund in the world. That this is an ETF, but the mutual fund that this is based on was started in 1991. That we do think this is like the oldest green fund. And this is one where we did a bigger overview of his approach, but he's not going to invest in Tesla. You can see the companies here: Ecolab, Eli Lilly, Prysmian, Amphenol, Schneider Electric. The Tesla won't be in here. And that what's fun is that, again, it'll give you the top 10 holdings. This is one where they are transparent, where we can download all of the holdings. So I'm just going to show you how to do this. That not every fund lets us do this, but a lot of them will. So I'm just going to zoom in here. Oh, now hold on. It opened an Excel spreadsheet. So for me to be able to show this to you, I'm going to have to swap over. Give me one moment here. That if we go here, I believe it's this one. Awesome. So you should be able to see this. Let me see if I can make it a little bit bigger. There we go. So again, and then what I can do here is just do Control F for my little search. I'm going to search for Tesla. It is not in here. We could not find what you were looking for. Again, this is often what we want to do, is to be able to download a full list of holdings, and then you can scroll through them. If there aren't that many, there are only about 40, 44 companies in here, give or take. And that, so I can verify that. Sometimes there will be hundreds, sometimes there will be thousands of companies. So that is why I do love that search feature. So really, that's what we want to do when it comes to the getting rid of Tesla from our portfolio. What we want to do is understand that we're going to want to be able to build a pie chart. We're going to want to be able to look at our investments. We're going to want to understand the methodology if we can. Sometimes they make that information available. Sometimes I'm a little bit like Indiana Jones trying to find this stuff. From there, we're also going to want to find a list of holdings that in a perfect world, we would get a full list of all holdings. And then from there, we can identify whether Tesla's in there or not. So Jackie asks, any recommendations for an alternative to QCLN? Jackie, I can't tell you exactly what to do otherwise, but what I would say is that I would take, I know for, you can take a look at my list of doing more good stock ETFs. I'm quite confident it's not in CESG.B. I know for sure it's not in AGSG. The other clean energy ones, a lot of them do have quite a high carbon intensity here, and they do have some fossil fuels in there. In a dream world, we're looking for something with a very low fossil fuel score that also doesn't have Tesla. You might consider, if you're looking at clean tech, AGSG is certainly worth a closer look to be able to see whether that is something that you would want to swap it out for. But QCLN, it is really what I call like the sexy one, where it's got a lot of like sexy renewable energy. We're a little bit limited in terms of the Canadian dollar ones here, but that's probably where I would start you on your research journey, would be this list of doing more good stock ETFs to be able to see what's in there. Gail says, actually, Tesla used to be the largest holding in QCLN, so third is better. Absolutely. These things tend to be weighted by the size of the company. And so at some point, like I said, it was higher and then it has come down over the last 3 months or so. So that's why it's probably dropped down. Okay, so Allison is asking, if divesting by moving our central investment from ETFs that include Tesla, et cetera, to cleaner ETF options, what should we be consider in making the switch and when? Whoo, Allison, that is a big question. So Daryl and I, my colleague Daryl, he's a dear friend of the show. We did a show, I want to say it was it last month? Yeah, I think it was about a month ago, where we talked about how to fire your advisor. And that really how to switch, whether you're switching advisors or switching funds, a lot of the considerations are going to be the same. Really what we want to worry about is what are called capital gains. This is a thing where, Allison, is probably a bigger conversation for us to have if you want to talk about sort of your specific situation and how that works. But honestly, for the most part, it's pretty easy and straightforward. But there are some little things that you might want to consider, such as tax implications, especially if you've filled up your RSP and your TFSA and your tax shelters and you're investing in taxable accounts. That's where there might be some taxes involved there. Branded is following the round the world pie, which I've been doing. What might be a good alternative for QCLN? Will any of those doing more good stocks be fine to maintain the essence of the round the world pie? Yeah, Brandon, what I would say is in terms of the round the world, when the model portfolios, pretty straightforward. You can really swap things in and out. Again, this is very much the icing on the cake. As far as these doing more good ones, CESG, I believe, is the most like global fund. Let's see whether Tesla's in here or not. So this could be a good case study. This is one that uses the Sustainable Development Goals, the SDGs. And what we can do here is we can look at the portfolio. You can see it is very globally diversified, US as well as a lot of other countries. Now, this one only has the top 15 holdings. So let's see here whether Tesla's in here. It's not. Now, is it hiding out in the bottom? Maybe. So this is where, let me see here if they do have a document section. So this is a little trick that I've used, is that sometimes what I find is we get these sort of annual information documents. We also get these financial reports here. They legally have to do this twice a year. Typically what I'll do is I'll look for the most recent one, right? Which in this case is going to be, it looks like it's going to be the 24th, December 31st, 2024. So let's just see here if they happen to give us a little bit more. Now this is like a 700-page ETF, my goodness. So let me just find this. This is going to be Impact. Oh, we have way too many, but it does give me the page down to page 489. Oh my goodness. This is me being Indiana Jones here to show you 489 down here is the MSCI World ESG Impact ETF. So here's where they should give us a summary. Now I'm hopeful it'll be the full list, and it looks like it is here. And so this is where we get the full list of holdings. Now this is a snapshot as of December 31st, so I can't promise this is up to date. We can go through here and I can see for USA, Tesla is not in here. So this is where it would show up. I can now confirm, I can give you the thumbs up that at least to the best of my knowledge, that inside of CESG.B, this one, which is out of these, probably the most diversified of these funds, that Tesla is not in here. I'm hoping that's going to be helpful. Really, before I get into the Q&A, just want to remind folks of the 3 ways that I do help people when it comes to aligning your financial goals with your values. That the starting point for a lot of people is going to be the classroom. And we'll link to this in the show notes, that this is the starting point for a lot of folks. This is my classroom where I've got online courses. We do a monthly Ask Me Anything session. It's $10 a month or $100 a year. So this is really like your first step in terms of starting to figure this stuff out. If you do need DIY coaching, then I'm here for you. You can book a meeting with me, reach out on my website, goodinvesting.com. There's like a free consultation link there. I'm not cheap. I'm about $750 an hour. There are discounts available. I've got some limited discounts available every single month. So if that hourly fee is a barrier, just let us know. I'm still happy to work with you. We'll figure it out. And then if you're just like, Tim, the DIY thing, no, thank you. I would very much prefer to have a manager. Then fantastic. I've partnered with a firm called Genesis Capital Manager. This is Daryl, who's the lovely individual who did that How to Switch Advisor webinar with me. If you go to goodinvesting.com and the how we help, there is that full service button down there. So if you are looking for a full service solution that doesn't have Tesla, Genesis, and Daryl, definitely get the thumbs up from me. Okay, so now I'm happy to go into a more sort of general Q&A. I'll go back up and see if I've missed any questions. So Elizabeth has a question. I do hold ETFs. Where can I find a good description of what I should see in my monthly portfolio financial reports in regards to dividends from ETFs? I get a monthly report that indicates that I was paid a certain amount of dividend, but it's called a trust unit and I never get the cash, nor do I get any more shares. So where does that go? This is a really good question. Generally speaking, when dividends are paid to us, they do show up as cash in our account, ready to reinvest. The only reason that cash wouldn't show up is that if you do have something called a DRIP set up, DRIP is Dividend Reinvestment Plan, then that would automatically buy more shares. But you're saying you don't get more shares from that. So honestly, this is something where I might ask you for a little bit more information to be able to do it. to be able to understand. Elizabeth, I do see your comment here just recently. This has been very helpful in terms of how to research what I'm thinking of investing in. Took the Ontario Securities course many years ago, hence the comment about gamblers versus investors. So really when it comes to this, it really is going to be, it's going to depend on the platform that you've got and that everyone is so different. So I think this is going to be a bit of an it depends question. Okay, so you're saying, what is a platform? I hold a bank, I hold a TFSA with my bank and they send me monthly statements. So the platform is going to be with your bank. That's the platform is going to be actually like the bank that you're doing it with. It's going to depend whether if it's with RBC, whether it's RBC direct investing or whether it's mutual funds. There's a good chance that they're just automatically reinvesting those dividends for you, Elizabeth. But I would need to see a statement or help you understand that in order to verify. Maybe it's phantom income. Yeah, it's just showing up. CBC self-managed TFSA. Okay, so if it's self-managed TFSA, it should be showing up as cash. If it's not showing up as cash, we have a little bit of a problem there. So that might be something that you and I want to unpack. So this might be something where I would suggest you reaching out for a free consultation on the website and that we could have a little chat and I could absolutely help you unpack that. Mary asks, what does ETF stand for? Mary, great question. Forgive me the acronyms. ETF stands for Exchange Traded Fund. So these are funds that are traded on the exchange. ETFs are very popular, especially for do-it-yourself investors. That's typically how we do it, is that we buy these ETFs, these exchange traded funds. They're very similar to a mutual fund that you might buy from the bank, or if you were to work with a full service advisor like Daryl, they would be called a pooled fund. But basically funds are just these like buckets with a whole bunch of different things inside of them. And that the ones that we buy as DIY investors are called exchange traded funds, because these are funds that trade on the exchange. So Daniel does ask, full service partner is like a family office. Not quite. Family offices are actually unique, Daniel. Family offices are for the super wealthy. Family offices are if you're like a multimillionaire, you might have your own family office, or you might join a family office with a couple of other families. Full service is really hiring an advisor to do everything for you. So a lot of independent advisors might be with a firm like Edward Jones or something like that. The relationship that I've got is with Genis Capital Management. So really full service is going to be the investment management, but it's also going to be financial planning. If you're a DIY investor, you do the investments yourself. If you need a financial plan, something like a retirement plan or an estate planner saying, Tim, do I have enough money for retirement? You might have to pay extra for that to get a financial plan. Whereas with a full service investment management, that financial plan should be included with your investment management. So that's really going to be the difference. Okay, so let me just go through these. So Gail asks, buy or wait, I have cash. Gail, I don't know. I don't have the crystal ball. I don't have the time machine. I don't have either. I just don't know. For me, I love buying the morning after a really bad day. So if you're ready to go at 9:30 a.m. tomorrow and can do that. That said, could this be the start of a trade war? The last time we had tariffs this high was 1930, where it led into the Great Recession there, the big crash. It's really tough to say. I always suggest clients do invest, that I would rather you put your money to work. And I do think that with the bad news that we got today with markets responding the way they did, I do feel that if you're thinking about it, probably now's a good time if you've got the cash. Otherwise, the problem with waiting is that then you're looking at it every day, being like, do I buy now? Do I buy now? Do I buy now? My preference is always just put the money to work, and that we certainly hope for the best. Allison says, if transferring ETF funds within an RSP, are there still potentially capital gains or tax implications? No, Allison. Anything inside of a tax shelter, RSP, TFSA, for our American friends, if it's in your Roth IRA or your 401k, those are all tax shelters, zero tax implications. So it's only if you've got your tax shelters full and you've got unregistered, that's when we need to worry about taxes. Awesome. A couple people had to go. That's great. Elle asks, as ETHO is 80% US stock, GGRO could be a good ETF to diversify. So yeah, Gael, definitely. I think that people who are looking to get away from the US ETHI, we do want to diversify away from that. GGRO is going to be the mix, but if you really want to keep your ETHI and still diversify, something that you could do. Okay, I'm going to get nerdy for a moment. This is my list. I've got my list here, but all of my free resources down at the bottom, I do have this very nerdy Google sheet, okay? So I hope people won't get overwhelmed by this. This is why I keep it hidden. But this is my list of all the different sustainable ETFs in Canada. And that, you know, that really what we might consider, Gael, is under developed equity. Because you've already got a lot of US, what we could do is look at the ones that are for Canada, and we could look at the ones that are developed. That these are the ones that are going to give us sort of more diversification outside of just US. So the thing with GGRO, like this is balance, so this is GBAL, so not GGRO, but let's do GBAL here. That if we look at the holdings, remember this is an ETF of ETFs. Oh, I have to zoom out. I think, oh, hold on. Top 10 holdings, here we go. So remember, this has US stocks with XUSR, but it also has Canadian stocks. It also has EAFE. If the goal was to switch everything over and sell ETHI and buy something, then this might be a good solution for you. But if you are just looking to bump up the allocation outside of the US, then you might consider looking at something like XCSR to bump up Canada, or XDSR to bump up Europe, Australia, and the Far East. You can consult my spreadsheet. You can see here's XDSR. This is going to give you more exposure to Europe, Australia, and the Far East, right? Any of these on this list would do that, but this is one that we know is fossil fuel free. Leslie asks, how many ETFs should you have? Oh, this is a hard thing because Leslie, if you have the right ETF, if you have one of these all-in-one ETFs, I'm okay with that. You can literally have one ETF and that is no problem, right? If you buy the frozen pre-made pie, you buy one thing and that's it. You're good to go. But if you want the individual ingredients, like the way we used to have to do it. So before we had these all-in-one ETFs, I'm going to go back to my nerdy sheet. We would have to buy one for Canada, one for US, one for EAFE, Europe, Australia, and the Far East. Sometimes people would do an emerging market one, although tricky to do when it comes to sustainability, the emerging markets, but that's how a lot of people would do it. And then one for bonds. So it used to be that we would have to buy 5 ETFs and have it in specific percentages and bake our own pie. But now really it is really with these all-in-one ETFs, or if I show you on the spreadsheet, we have these all-in-one ETFs down here. That these are, if you get the right mix, if we have the right mix of stocks and bonds in here, you can literally buy one ETF, which is amazing. So it's not about the number of ETFs that you own. What matters is what's inside those ETFs and being properly diversified. A properly diversified portfolio is going to be a mix of both stocks and bonds, right? We want the crust and we want the filling. And then for the stocks, we do want to be globally diversified. So we should have a mix of Canadian stocks, US stocks, and developed or EAFE, Europe, Australia, and the Far East, or international stocks. That's how we know we have enough diversification in our portfolio. And obviously, this is absolutely something that I can help with. Annie asked, U.S. situation is such a shit show. Any thoughts on rebalance to reduce U.S. portion? Or if the U.S. tanks, the world tanks? I've shown you here, no problem to reduce U.S. a little bit. I've shown people how to do this. Perfect. Okay, yeah. Gail was my partner who asked, I think continue to buy his plan. Okay, perfect. Yeah, I've got Justin here says Dale Brown from Dennis is great. Agreed. Brandon asked, do you have any thoughts of how the various GBAL, GGRO, etc. compare to any of your sample portfolios on your website? I.e. close. Yeah, so the GBAL and GGRO is actually part of my organic couch potato. So this is if we do the free resources, and these are probably due for a little update, but the organic couch potato pie, Brandon, actually does include GBAL. So this is the one. So just note that it is very much the organic couch potato that I do for GBAL there. Daniel asks, what's your take on individual stock picking, though, Tim? In moderation, of course. Yes, very much in moderation. I don't like individual stock picking. I think you're blindfolded throwing darts at the board, right? It's more about luck than it is about skill, Daniel. If you want to do it, you can carve out maybe 5% of your pie for, I call that mad money, right? So that's how I do that. I really don't suggest it. Really prefer not to. Obviously, it's your money. You can do what you want. If you are going to do it, really small, and just know that it is more about luck than it is about skill. I think we're going to call it there, folks. This has been a fantastic webinar. Thank you so much for joining me. Really appreciate it. Can't tell you how much I mean from this, how much it means to me that y'all are here. Stay safe out there and look forward to our next webinar. I've got something nice cooking for that. I'll give you the little spoiler. It's not quite announced yet, but the next webinar, the topic is going to be green bonds. So really excited to dive deeper into some green bonds. I've got a great guest lined up for that. Make sure you're signed up for, or I would say keep an eye on the newsletter. If you registered for this, we added you to the newsletter. Keep an eye out for the next webinar. Thank you so much, everyone. Have a wonderful night. All the best. Bye.